Cesar Masri, regional strategist at Goldman Sachs. He joins us from Hong Kong. Cesar, hi, morning. Despite Asian equities not really performing well, you remain constructive on Asian equities. What gives you this kind of confidence?
Everything's about perspective. Asian equities were actually up about 30% in the second half of last year. So, I'd be quite optimistic there. Looking out to the course of 2013, what we really think will drive markets this year is earnings growth. Earnings have grown by basically 0% for the past 2 years. We're looking for an acceleration to about 12%. And the main reason why is operating leverage.
Cesar, but at the current juncture, as a house, Goldman Sachs is clearly overweight on India. So what is stemming, or what is fueling your optimism?
Yeah, so our forecast for India in calendar years last year, GDP was up about 5.1%. We're looking for an acceleration to about 5.8% this year and 7.2% in 2014. The very near-term data has been a little bit noisy, but we have seen a pickup in industrial production in January, and the February manufacturing PMI also suggested some acceleration. So it may not be as near-term, but over the course of 2013, we certainly expect to see a growth pickup. And remember, equity markets tend to move ahead of some of the economic data, so that we remain even near-term optimistic on the equities.
So how does India look on valuations front? Because you retain your 7,000 year-end target for the Nifty.
Yeah, so Nifty currently trades at about 13.5 times earnings. To put that in a historical perspective, the 10-year average is about 15.5 times. The 5-year average is about 14.5 times. So we're well below average. We use macro models that take into account the global growth situation, India GDP, as well as inflation. And that model suggests that we'd get to about 14.3 times earnings at the end of this year. So still below historical averages, but with about 14 or 15% earnings growth, that stands out to be a pretty attractive return in total return space.
Since you believe that growth has now troughed out for India, would you play this theme by stocks levered into investment cycle?
Yeah, so I think in the near term, you want to stick with some infotech stocks that have performed quite strongly as the currency has remained weak. But again, as we look out into the course of the year, as growth picks up, again, the RBI has cut rates. So hopefully we see some investment pick up towards the back end of the year. I certainly think you'd want to step into the industrial space. And again, I think the equities might move a little bit ahead of the economic data. In the near term financials, we've had a decent, strong view on more so on the private sector banks and the public sector banks, but I think you need to remain selective in that area as valuations have run up a little bit.
Cesar, Indian market performance is dependent on foreign flows, which in turn has an impact on currency. What are your thoughts on the Indian currency, and where do you see Indian currency could move in next 2 or 3 quarters?
So in the near term, we do see some risks on the currency side. I think some of the foreign flow has subsided a little bit. It's still been strong for the course of the full year, as well as the current account deficit. That's certainly been a big concern. That's blown out to sort of record-wide margins, as well as some of the political noise. So in the near term, we're a little bit more cautious on the rupee, looking at about 55 for the next 3 months, and then going down to about 53 on a 6-month basis. But as we've shown in our research, the equity market and the currency can move in different directions. In the very near term, they look correlated, but keep in mind, for example, that about 2 months ago, the currency was very near its all-time weakest levels, and the Nifty was only about 6% off its all-time highs. So I think you can have very different outlooks on the currency and the equity market at the same time.
So do you see political risks to your prognosis for India?
Certainly the political calendar and political headlines have taken the markets. So there certainly is going to be risk there. And again, I think that's more on the currency side, because the currency trades more the current account deficit as well as the fiscal deficit, and depends more, I think, on the foreign inflows. What really drives the equity market is the growth cycle. And we have high confidence that that has bottomed out, in part because some of the data have improved and because we've already seen some policy action and some rate cuts, which should help spur growth. So I think the political calendar will remain active, but I'm still quite optimistic on the equity front.